All right, you now have the 10-year a full 1% plus lower than the 2-year. And that, again, I mean, historically, that's something that has to raise alarm bells from investors. That, again, that if you look historically, that signals something down the road. But
Hello and welcome to today's video. In this episode, esteemed analyst Gareth Soloway shares his expertise on the latest market developments and expresses his concerns about certain market trends that are flying under the radar. How will this affect Bitcoin, the assets market, and the crypto market in general? Is the US dollar in danger of a plunge, or will it strengthen? The US dollar would play a vital role in what we're about to experience in the markets, and it's important we look at how this would affect investors and what markets would be pulled by the influence of the dollar. But before we dive in, be sure to subscribe to this channel to stay up to date on the latest news regarding cryptocurrencies and the global economy. And if you find this video informative, don't forget to give it a thumbs up. Now, let's get started with Gareth Soloway's analysis of the 10-year yield chart and the warning signs in the market landscape.
There's some things that I'm seeing in these charts. And so this is the 10-year yield chart. And what we had was a wedge pattern that was a bullish wedge pattern. We broke out yesterday with that solid economic news that we got, the GDP revision to 2%. And then today we had the slightly better than expected PCE number, which kind of brought back in from this next resistance level, which is what to be expected, right? We broke out of the first one, but the second one hasn't been tested yet. It has to pull back. But this is the key, is that are we going to see a bigger breakout on yields if this channel, see this beautiful, this is actually a bull channel. In fact, it's very, very similar to what we've seen on gold play out over the last 4 years or so, the same pattern formation. And if this starts to break above this line, you at least are headed back to 410 and then maybe the highs of 436 on the 10-year. And the question is, the higher rates go, what do risk assets do? That's the question I have. And I think also what's concerning to me is the divergences that we're starting to see. So if you look historically at the 2-year versus the stock market, or the 10-year versus, there's a very clear kind of coordination between what goes on there as well as the markets. And we've seen a divergence over the last, so long, let's say the last 6 months in the market with these signals. So something weird is going on here, something that is unsustainable if you look historically at the markets and at these other signals. If you coordinate this with COVID, there's COVID and there's your money supply increase, and then look at the run as money supply goes up, then look as money supply flattens and starts to decline, we have this. The problem is that this action here is down money supply while we have been rallying. And that, again, is problematic. That tells me there's something brewing here in the markets. And it may not play out for the next 6 months. We don't know. But at some point, there has to be a revision back in the markets or in money supply to some central point.
On June 27th, the Dow Jones Industrial Average declined by 160 points, accompanied by 0.4% and 0.2% downturns in the S&P 500 and Nasdaq Composite, respectively. Interestingly, while the stock market experienced this decline, the 10-year Treasury yield dropped by 2 basis points to 3.06%. In contrast, oil prices rose by 0.3% to reach $110.90 per barrel. The dollar index displayed resilience, increasing by 0.2% to 104.82, while gold prices dipped 0.2% to $1,838 per ounce. Over the past 6 months, the US market has experienced a notable divergence, with certain sectors like technology and consumer directionary continuing to ascend, while others, such as energy and financials, have witnessed significant declines. The market's divergence indicates a shift in investor behavior, reflecting a growing selectiveness in their investment decisions. Investors are no longer simply buying stocks based on their upward momentum. Instead, they're seeking out companies that are better equipped to navigate the existing economic challenges. Gareth talks next about the causes of this divergence and recent events that have impacted the market.
At least from my perspective, the divergence can't last forever. At some point, the markets have to come back in. But I do think that there was so much money on the sidelines because investors were so worried about a hard landing. and now everyone feels like they missed the boat, that they're all chasing, and that's creating this divergence where people are saying, hey, listen, we're going to have this beautiful soft landing. Everything's going to come up roses. And so they're willing to kind of chase stock prices up at these levels. And I'll show you another thing that definitely is a bigger and bigger concern of mine, ignoring the trend lines, but just looking at the yields. All right, you now have the 10-year a full 1% plus lower than the 2-year. And that, again, I mean, historically, that's something that has to raise alarm bells from investors. That, again, that if you look historically, that signals something down the road. But I agree with you. I think there's probably enough liquidity in the market to keep us from anything major until the end of the fourth quarter. But I do think we're due. I mean, either way, markets have gone parabolic. VIX is so low now that no one is expecting any issues. And that's usually when we see some issue. And by the way, last weekend, we almost saw something, right, that the market wasn't expecting, which was the attempted coup in Russia. But by the time the markets reopened, everything was all good again.
The Nasdaq Composite Index delivered its most remarkable first half performance in 4 decades, soaring by an impressive 32%. This outstanding achievement can largely be attributed to the robust performance of technology stocks, including industry leaders like Apple, Nvidia, and Meta. Apple in particular achieved a historic milestone on June 30th, 2023, as the first publicly traded company to conclude a trading day with a staggering market value of $3 trillion. Demonstrating its unwavering growth, the company's shares climbed by approximately 2.31% on Friday, reaching new heights. On the other hand, discussions about de-dollarization in the US market have surfaced, potentially leading to a weakened US dollar. Factors such as rising interest rates in other countries, sluggish economic growth in the US, and political uncertainties contribute to this possibility. A decline in the dollar would have significant implications for the global economy. Gareth shares his expert insights on these brewing topics.
For the NASDAQ, a couple things to just keep in mind is you have a little bit of a parallel channel formation here, where if we drag this down, and this is kind of what we're retesting now, but what we can see here is that the low end, look at that, you have the pivot low and pivot low on the downward movement aligning perfectly with the pivot here, pivot and pivot. So again, this is a big level for the NASDAQ. It's not to say it can't get through that level, but it is a level that I'm very closely watching to see, can we push through? Now, interestingly enough, on Apple, everyone talking about the $3 trillion valuation today and very fairly talking about it. You can see you have a parallel channel here, and we have actually gone just a little bit above that channel. So that is interesting in and of itself. But I do want to just point out to people that Apple is above its double top from 2021 by a decent amount, but market cap wise, it's now hitting a double top. And the reason is because you've had so many share buybacks going on with Apple that the market, like if you look at the market cap of Apple, now it's finally back to the same market cap it was right back here, which again, I look at that and I say, okay, is that a double top on the chart of market cap, and is that more important? So big test next week also for Apple in terms of that double top market cap $3 trillion factor. Brings up the dollar chart here too, which is very interesting because you're kind of in this tightening wedge pattern. The question is, do we break down or do we break out on this chart? And that obviously will have implications for gold, crypto, as well as stocks. Generally, this pattern is a breakdown pattern. Doesn't guarantee it, but about a 60-40 probability that this would break down. Again, we've heard so much about the de-dollarization aspect and more about it. I think for me, it's a very longer term play where, the dollar will break and then it will go down, but it's not as volatile, obviously, as what we're used to with crypto.
What do you think about Gareth's analysis and predictions regarding the stock market? Do you agree with the notion that the US dollar might experience a decline in the upcoming months? Feel free to share your perspective in the comment section below. And remember to show your support for this video by giving it a thumbs up and subscribing to the channel.